All right, Nick, stay right there. Let's bring in Peter Churchouse right now. He's with Morgan Stanley. He joins us from our studios up in Hong Kong. Peter, it's been a while. Good to have you back, sir. Where is dollar headed from here, do you think? I mean, we've got yields, I mean, certainly not as high as 4.6%, down about 4.4, but I mean, it makes a pretty attractive proposition, especially for foreign money. And of course, what a lot of people are watching is what Asian central banks continue to do, whether they continue to favor dollar assets or not.
Well, my sense here is the dollar is never, ever destined to collapse in the next 12 months or so for the sort of reasons you've outlined. Quite frankly, it's the currency of choice around the world for most central banks and most investors. Who really wants to push up the price of the yen? Because every time you do that, the central bank in Japan pushes it back down again. So you're battling the yen. Europe, I think clearly there has been a nice rally in recent months in the euro. But we look like we're seeing policy paralysis in euro. The one-size-fits-all economic policy clearly is running into troubles there. We're seeing deflation in Germany, Italy, France, almost there as well. Not a lot of reason to be very optimistic about Europe. And yet America, we're seeing growth coming back, profits looking good, equities looking good. I think, quite frankly, we're going to see quite decent support for the dollar.
All right, we have to note, though, I mean, what about the twin deficits? That continues to be a concern. I mean, we can't ignore that.
Yeah, but we've had a trade and current account deficit growing for the last 6 or 7 years, and that hasn't derailed this whole situation. If you think about it, quite frankly, the major surplus-generating countries in the world are in Asia. They have a huge vested interest to keep pumping dollars and buying dollars with these huge trade surpluses. Quite frankly, by buying dollars, it supports the U.S. consumer, who's going to buy more and more Asian goods and keep these Asian currencies going. So I think these Asian central banks and governments would be fools not to keep funding this deficit to a certain extent. So I don't think this is going to stop anytime soon.
Peter, got to ask you that. I mean, strength in dollar going forward, I mean, a lot depends, of course, hinges almost entirely on whether or not we actually see a U.S. recovery coming through. I mean, true, the most recent bits of data have been pretty good in terms of retail sales, also housing, but I mean, unemployment still has not improved significantly. That is still the major Achilles heel for the U.S. economy.
Yeah, let's face it, have you ever seen all the economic data in the last 10 years pointing all in the right direction or all in the wrong direction? We're always seeing mixed signals in the economic data. Unemployment is a lagging indicator. We all know that. So, you know, my sense here is that, yes, we're into an economic recovery in the U.S. It's just how much. Quite frankly, with the amount of liquidity that's being pumped into the system, firstly by the Fed and, of course, by the budget cuts, I think it's almost inevitable that we're going to see a decent second-half economic recovery. It's just a matter of how much, and the world is going to trade off that.
Peter, then what about all the stock that Asian central banks over time gradually are going to want to, and indeed are making efforts to shift a little bit more, rebalance their portfolios, move a little bit more of what they have into euros? I mean, is that dead in the water, or will that continue?
I think over the long term, your 5 to 10 years, I think that's almost inevitable. And think about it, if you could conceive that maybe 10 years from now, if we have the Chinese renminbi floated freely, you could even see the renminbi become a second reserve currency around the world. So I think that trend is likely to continue. But right now, with the yen and the euros, the only real choices, and there's only so many Aussie and Kiwi dollars or Canadian dollars you can buy, and the problems we're seeing in Europe and the problems we're seeing with the yen, I think the dollar still has to be the currency of choice almost by default.
All right, Peter, fair enough. We'll leave it there for now, but we'll come back and talk more in just a little bit there. Peter Churchouse, our guest host for this leg of Wrap. Morgan Stanley joining us from our studios up in Hong Kong. Also, Nick Hastings, Dow Jones Newswires from his perch in London. Let's get back to Peter Churchouse, our guest host for this leg of Wrap. He stays with us from our studios up in Hong Kong. He's with Morgan Stanley. Peter, earlier on, just a couple of minutes ago, before we went to the break, you were sounding pretty positive on the U.S. recovery story, also continued dollar strength. But I mean, the big if with both of these stories is what will or could happen with the U.S. bond market. I mean, fine, we have had yields backing down, not 4.6%, but still, I mean, there's a lot of paper, $50 billion, if I'm not mistaken, in terms of refunding coming up next month. I mean, that's certainly going to put pressure on prices and pressure up on yields.
Well, that's right. I think clearly over the last 6 weeks, we've seen probably the biggest rise in bond yields in the U.S. For 2 decades. So that's been a pretty steep sell-off in the bond markets, generally speaking. And we can understand some of the reasons for that. But I think investors are probably sitting back right now and saying, well, you know, maybe that sell-off has been a little bit overdone. Yes, we know there's a lot of paper coming. There's a big budget deficit to finance and so on later this year. But really, the prospects of rapidly rising inflation probably aren't there. So really, are we overreacting to that? And secondly, I think with this move back into US dollar-denominated assets that we've seen in the last week or two, I think that's providing a bit of support as well.
All right, Peter, stay right there. Let's get over to Bob O'Brien. He's standing by at our U.S. headquarters. Bobby, there, can you hear us?
Yeah,
Yeah, Bob, go ahead. How's it shaping up over there?
Yeah, you know, it looks like a pretty quiet day, frankly, Martin. It's a little bit of a lull in the earnings reporting pace as we come to the conclusion of the second quarter reporting season. There will be a response to Hewlett-Packard, and it looks as though the response is going to be to the downside. And of course, as a Dow component, that could really dictate the pace of how the Dow trades. And we did manage to finish modestly higher in yesterday's trading session, despite a little bit of cross currents. There was a concern about the bombing that took place in Iraq, as well as the response to some of the earnings that we saw earlier in the week. So it's been a fairly resilient market with most of the major averages. The NASDAQ continues to trade at its highest level in more than a year. And the technology sector has been pretty much the engine of the growth here. So we'll have to see whether or not the Hewlett-Packard numbers disrupt what's been a pretty positive trend. It certainly raises some questions about one of the tenets of the recovery, which has been that spending on things like PCs and workstations was going to begin to pick back up. Hewlett-Packard kind of putting a lie to that little theory. But absent that, not much in the way of data, not much in the way of earnings. A couple of retailers will be posting their quarterly results, but otherwise looks like a relatively tame day. That's being reflected in the futures, which are showing very modest moves from the opening bell. Of course, still have a couple of hours to go before we actually start the trading action here.
Absolutely. Hewlett-Packard one to watch, down about 11%, very sharp losses after hours. Peter, in Hong Kong, let's get back to you. Bob was just talking about the tech sector there. The hope, or the bet, I guess, is that we're going to finally see the last leg pull through of the business cycle there, capital expenditure, IT spending, etc. There have been increasingly positive signs, HP perhaps the exception. A lot of others, big U.S. techs, are reporting their comments, their numbers have been a bit more positive. Are you buying a tech sector recovery, Peter?
Well, I think we are actually, certainly in this part of the world, in Taiwan and Korea and in China. We're seeing quite good numbers coming out of many of the tech companies here. Earnings are surprising, if anything, to the upside. Certainly top-line growth is looking quite good. I think some of that is really market share gains being driven through here in this part of the world, in Taiwan, the big producers in that part of the world, also in China. So it's also an improving margin and a top-line game as well that we're seeing here in this part of the world. And I think we're going to be seeing earnings analyst revisions more to the upside than the downside going forward through the second half of this year. So yes, we're looking reasonably favorably disposed towards tech in this part of the world at least.
All right, Bob, you want to jump in on this?
Yeah, Peter, a lot of U.S. investors that are playing technology have been very Asia-focused. Some of the China internet plays have been the best performers this year. Is that appropriate for U.S. investors at this juncture?
Well, I think so. Some of these, the internet stocks, of course, are relatively small stocks in market cap terms. But I think people have been focusing back, even in the U.S. names, and some of these fallen angels, so to speak. And I think people are starting to look at markets like China, where these companies are demonstrating to some extent that they do have a real business, and certainly the growth potential in those businesses is huge if they can get around the corner of actually getting from being in the red to being slightly in the black. These companies, I think, are going to demonstrate very, very strong growth as we see Chinese consumers taking up more and more computers, more and more mobile phones, more and more sophisticated mobile phones, short messaging services, all these sorts of things that have become very, very big time in markets like Korea and Japan, and we're expecting to see a lot of that migrate into China.
All right, Peter, stay right there. We'll come back and talk more in just a bit. Peter Churchouse there, Morgan Stanley, our guest host for this leg of the show. Also, Bob O'Brien, looking ahead to U.S. trade from our U.S. headquarters there. Thank you so much. Lisa Oak there out at our stocks desk. Let's get back to our guest host for this leg of wrap. Peter Churchouse, Morgan Stanley, staying with us from our studios up in Hong Kong. Peter, earlier on, we were talking about the U.S. recovery story. Lisa was just talking about signs of real recovery, domestic demand driven in Japan. If both those are true, you've got two big tides which could potentially lift the rest of the Asian boats, so to speak. I mean, does that hold for you?
I think very much so, actually, Martin. I think Asia is in a case of 5, 4, 3, 2, 1 liftoff kind of phase. And I'd put that certainly in markets such as Singapore and Hong Kong. We've already had quite a lot of positive trends out of Taiwan and Korea, but I think these two markets in particular have really lagged in the last 12 or 18 months, and in the last month or so are now starting to pick up. And my sense here is that you can sense the recovery is happening. It's a palpable sense here in Hong Kong. Anecdotal evidence is definitely suggesting that from the retail side, from the hotel side, from the restaurant trade, and we're even starting to see it after 5 or 6 years in the property sector. So I think we're on the verge of a significant takeoff here.
Okay, what's your favorite market, though, Peter, out here?
Well, at the moment, both of those two markets we're focusing on, particularly Hong Kong, because it's been a market that has had no expectations on the part of investors. It's been marked down very badly over the last couple of years. The deflation, the weak economic numbers, the very weak property sector, and in fact, earnings still look pretty weak at about 6 or 7% for the market. But it's the market where I think you could see the biggest earnings revisions going forward over the next 6 months or so. The market certainly isn't wildly expensive, and a lot of these companies would, if we see any sort of pickup in the economy, you could see a very significant pickup in operating leverage on these earnings. So that might be where you could see big surprises, more so than Korea and Taiwan.
Yeah, indeed. I mean, in the last couple of sessions, I've noted that a big foreign money has been going into cyclicals in Hong Kong as well. What about property, though? I mean, still very heavy weighting for the Hang Seng. What are the prospects there?
Well, yes, it is. It's still about 15% of the Hang Seng index is in property stocks. Property prices, as we all know, are down 60–65% in the residential market. But in the last months, we've seen a very, very, very distinct firming up in the luxury end of the residential market. After the announcement of closer economic partnership with China, we're starting to see liquidity coming back into the market. Activity is picking up. Any estate agent you talk to will have a big smile on his face as he's getting a lot more inquiries at the moment. But the mass residential market is still soft. There's still a lot of property for sale there, but we've probably hit bottom, and I wouldn't be surprised to see somewhere in the next 6 months a distinct upturn, and even in that mass residential market.
All right, Peter, good to talk to you, sir. Thank you so much for the time. Always good to have you on the show. Peter Churchouse there, Morgan Stanley, our guest host for this leg of the show from our studios up in Hong Kong.